In today's episode, we'll break down one interesting story in depth, followed by a shorter story. First, we'll talk about whether a miracle drug can change how we work, and then we'll talk about SEBI wanting to create a mutual fund distributor for bonds. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is 25th August. Coming to the first story. So GLP-1s began as diabetes treatments and then they became a breakthrough in weight loss. Now the promise is expanding again. Better health should mean people miss less work, stay productive, and remain economically active for longer. That last claim matters a lot. It's increasingly used to justify spending on these drugs, but until recently, nobody had tested it properly. And someone finally did. So their employment rate had not moved either. And if anything, the estimate leaned slightly negative, though it was statistically indistinguishable from zero. Now that finding comes from a July 2026 working paper circulated by the National Bureau of Economic Research in the US. 5 economists used Danish administrative records to track what happened after people started taking Ozempic. The paper has not been peer-reviewed yet, but it's the most careful attempt so far to test whether these drugs improve people's working lives. The answer is yes, just not in the way many expected. Now, this matters to us because India is now running its own version of the experiment at speed and without a control group. Semaglutide's core compound patent in India lapsed in March 2026, and dozens of generic brands entered almost immediately, many at prices far below what the innovator had been charging. Sales spiked, then growth slowed sharply within a few months. Meanwhile, an estimated 10.5% of Indians aged 20 to 79 were living with diabetes in 2024, while roughly 8% of adults were obese. So the disease burden is huge, the drugs are suddenly much cheaper, and nobody in India is systematically measuring what any of this does to people's working lives. Denmark, thankfully, measures everything. Now, before getting to what the researchers found, there's one important question. How do we know Ozempic actually caused any of it? That's harder to answer than it sounds, and if you simply line up Ozempic users against non-users and find that the users do better at work, you've learned almost nothing. People who show up at a clinic, get a prescription, and stick with an injectable drug for years are not a random slice of the population. They may be sicker in specific ways, but also better informed, more motivated, or more connected to the healthcare system. Any of those things could affect employment and income on their own. You would be measuring the kind of person who takes Ozempic and not what Ozempic does to them. So the researchers did something clever. They compared people who started Ozempic in its first 17 months on the Danish market with people who started the same drug roughly 4 years later. Then they matched the two groups on age, sex, diabetes, obesity, and a long list of social, health, and economic characteristics. So that left 7,011 early starters paired with 7,011 near identical later starters, covering 71.6% of everyone eligible in the early group. And the logic is simple. Both groups eventually took Ozempic, so they're much more alike than users and non-users would be. The crucial difference is timing. The later group therefore becomes a stand-in for what might have happened to the early group if their treatment had been delayed by 4 years. But there's one more caveat before we get to the results, because it shapes how we should read them. Everyone in the sample was between 30 and 59 when the study began, and 84% had diabetes. So these are not necessarily the people you picture when you hear GLP-1 today. This was not a broad weight loss population. It was mostly middle-aged people with diabetes, most of whom were already employed, taking the drug for the reason it was originally approved. So with those caveats in mind, what actually happened after people started taking Ozempic? First, most of them kept taking it. 4 years after starting, 75% of early users filled at least one semaglutide prescription that quarter. Now, that doesn't prove continuous use, let alone that every dose was injected, but it is a remarkably high persistence rate for a chronic medication helped in part by Denmark's heavy drug subsidies. And then the absences started falling. So, Denmark's main measure of long term sick leave generally captures medically certified absences lasting more than 30 days. Before treatment, people in the study spent about 5.5% of their months on such leave, but after starting Ozempic, that fell by 0.95 percentage points or 17.3%. Put differently, roughly 1 in 6 of those long periods of sick leave disappeared. And the effect took time. In the first 2 years, sick leave fell by about zero point 0.8 percentage points, and by years 3 and 4, the decline had widened to roughly 1.1 points. That's what you might expect if the benefits come from gradual improvements in health rather than something that changes overnight. Even other measures moved in the same direction. Municipality paid sickness benefits, which kick in after the first 30 days of an absence, fell too. The researchers also found fewer emergency department visits, fewer cardiovascular drug prescriptions, and fewer consultations. That makes for a coherent story, but there's an important limit to how far we can take it. The Danish records tell us about prescriptions, hospital visits, and benefit payments, but they don't tell us people's weight, blood glucose readings, or why each person went on sick leave. So the study can show that health indicators improved while long term sickness leave fell, but it cannot prove that those health improvements caused the decline in absences. Here's where the paper gets genuinely surprising. The same treatment that cut prolonged sickness absence by a sixth produced no detectable improvement in whether people were employed, how much they worked, or what they earned. And this is not just a case of noisy data. The estimates are precise enough to put a ceiling on what could be hiding underneath them. The researchers can rule out an employment gain larger than zero point 0.4 percentage points and an income gain larger than 0.7%. If there were a meaningful labor market payoff, it should have shown up. They also split the sample by sex, age, and education to see if the effect appeared somewhere else, but it didn't. Some estimates were even negative. So the explanation is not medical. It's institutional, and it may be the most useful idea in the paper. So in Denmark, employers generally cover the first 30 days when an employee falls ill. After that, the municipality pays sickness benefits to those who qualify. But for many lower paid workers, those benefits replace most of the income they would otherwise lose. So a Danish worker who's sick for 2 months may take only a small financial hit. And if that 2 month illness is prevented, their measured income doesn't rise much either. The money is still being saved. It just goes to whoever would have paid for the absence. So the employer avoids paying for those first 30 days and the municipality avoids paying afterwards. The economic benefit shows up not as higher income for the worker, but as a cost that never appears on someone else's books. Now, it's worth being clear about what this doesn't mean. This is an offset, not a verdict. The paper doesn't run a full cost benefit analysis, subtract these savings from the price of the drug, or measure things like whether people become more productive while they're actually at work. Ozempic pays for itself is not a claim this study makes. Around the same time, another NBER paper by Rebecca Diamond looked at American women taking GLP-1s specifically for weight loss. Among women who weren't employed before starting treatment, employment was estimated to be 26.9% higher over quarters 6 to 18. That is an enormous effect, and it's also one to treat carefully. So the full match study includes only 242 treated women, and the non-employed subgroup is smaller still. And a stricter statistical check puts the result just outside the conventional 5% significance threshold. And when all the women are pooled together, the employment effect gets smaller and is no longer statistically significant. But there's another complication. Diamond notes that the result fits two very different stories. Losing weight might make it easier for someone to work, or employers might respond differently to visibly thinner applicants. The data cannot tell us which one is happening. But this doesn't necessarily contradict the Danish paper. The two studies are looking at different people starting from very different places. Denmark's sample was mostly people with diabetes who were already working, so better health could show up mainly as fewer days away from work. But Diamond looked at women taking GLP-1s for weight loss who weren't working to begin with, so any labor market benefit could instead show up as entering employment. Now, Denmark's result is partly a product of Denmark's plumbing. Because workers can have much of their income replaced during a long illness, the financial gain from preventing that illness largely went to employers and municipalities than workers. But change the plumbing and the money lands somewhere else. In a system where a long illness can mean lost wages or even a lost job, preventing it could show up directly in the household as more hours worked, higher earnings, or a job retained. And so the government saving would be smaller for the simple reason that it wasn't paying much of the cost to begin with. This is more likely to be the shape of the effect in India, where most workers don't have a 30-day employer funded cushion followed by a municipality picking up the tab. Which is exactly why we need to measure the effect here rather than import the Danish estimate. The system is different enough that the Danish number tells us very little about where the economic gains would land in India. And the patients would differ too. Denmark's early adopters were overwhelmingly people with diabetes, a group with a lot to gain clinically. Now, a cheap, widely marketed weight loss drug can bring in a very different patient, someone with less illness to reverse and potentially less sickness absence to prevent. India's post patent market could increasingly include that second group. And right now, we can't see much of it. Pharmacy sales data can tell us how many units moved, but it can't tell us how many distinct people started treatment, whether they were treating diabetes or trying to lose weight, or how long they stayed on the drug. And that last part matters enormously. In Denmark, the effect took years to build, but a market where people fill 2 prescriptions and stop is unlikely to reproduce the same result no matter how many boxes get sold. So the useful question was never simply whether GLP-1s pay for themselves. It's who benefits financially, through which channel, and over how long. In Denmark, part of the answer was employers and municipalities quietly over 4 years through absences that never happened. But in India, we don't know yet. And the data that could tell us largely isn't being collected. If you prefer reading the daily brief instead of watching the video, check out the link to the newsletter in the description. Coming to the second story. So, SEBI wants to create a new kind of bond distributor. And it's proposed a new intermediary called a fixed income channel partner or FICP that would help people buy bonds through online bond platforms. And the inspiration is fairly obvious. Mutual fund distributors help take mutual funds beyond wealthy urban investors, and SEBI now wants to see if something similar can work for bonds. But there's just one complication. A bond is a much trickier product to hand to a commission salesperson than a mutual fund. So here's why this matters. India's corporate bond market is worth roughly rupees 60 trillion, but retail investors barely participate in it. SEBI has spent the past few years making bonds easier to buy, but distribution is the next problem it wants to solve. In a consultation paper released on August 21st, SEBI proposed allowing individuals and firms to enlist with stock exchanges as FICPs. And SEBI-registered online bond platform providers or OBPPs could then appoint them to find and assist investors. SEBI released another consultation paper the same day proposing tighter advertising rules for OBPPs, including restrictions around pitches such as fixed returns, passive income, and FOMO-style marketing. And the two papers fit together neatly. SEBI wants bonds sold more widely while trying to make sure they aren't oversold. Now, SEBI has already tried fixing access. In 2024, it reduced the minimum face value of many privately placed bonds from rupees 1 lakh to rupees 10,000. But before that, its 2022 OPPP framework brought online bond selling websites under regulation, requiring them to register as stockbrokers in the debt segment and follow disclosure rules. Now, that made buying a bond easier, but it did not necessarily make bonds mainstream. So SEBI's own assessment is that OBPPs have mostly attracted tech-savvy urban investors, but the investors outside that bubble haven't necessarily followed. So mutual funds offer an obvious template for what comes next. India has roughly 2.75 lakh AMFI-registered mutual fund distributors sitting behind an industry with rupees 79.5 lakh crore of assets. And distributors played an important role in taking mutual funds beyond the largest cities. Now here's how FICPs would work. So the entry barrier is deliberately low. An individual needs to be an Indian citizen, at least 18, have passed class 12, have a clean record, and hold the relevant NISM fixed income security certification. And SEBI is also creating two obvious pools of potential distributors. So, AMFI registered mutual fund distributors would have their enlistment fee waived, although they would still need the NISM certification. Stockbrokers that are not already registered in the debt segment could become FICPs too. And that second route could end up being just as important. An FICP would enlist with one stock exchange with the enlistment valid for 3 years and could work with multiple OBPPs. And they could help with onboarding, documentation, and KYC. But the actual transaction stays with the platform. Orders must route through the OBPP. The FICP cannot handle the client's money or securities or issue contract notes. And this is where things get interesting. The FICP gets paid by the OBPP out of its brokerage, and total charges to the client cannot exceed 2.5% of the investment value. Now, SEBI seems well aware of what can go wrong when you put a commission between a salesperson and a complicated financial product. So much of the liability sits with the OBPP. Now, the platform would be responsible for what its FICPs do. It must conduct Know Your Distributor checks and in-person verification, keep track of which clients came through which FICP, and resolve complaints within 21 days. For clients in remote areas, the OBPP must also call them to check for malpractice. And sales incentives cannot include gift vouchers, gadgets, or entertainment. And some of the riskiest products are simply kept out. AT1 bonds and unsecured perpetual debt cannot be sold through FICPs. And those restrictions matter because India has already seen what bad bond distribution can look like. So a few years ago, Yes Bank's AT1 bonds were sold as super FDs, but roughly rupees 8,800 crore worth of them were eventually written off completely. About 1,346 individual investors held them. So keeping AT1s away from this new distribution channel looks very much like a lesson learned. See, there is a reason mutual fund distributors worked so well. The product they were selling was designed for retail investors. But a bond isn't quite the same thing. So a debt mutual fund can spread your money across dozens of issuers, but buy one corporate bond and you're taking the credit risk of one company. A mutual fund gives you a daily NAV, and with many corporate bonds, figuring out whether the price you're being offered is actually fair is much harder. And if you want out, there may simply not be a buyer. Secondary market liquidity in many corporate bonds remains thin. But perhaps the biggest difference is how the salesperson gets paid. So an MFD typically earns a recurring trail commission as long as the investor remains invested. An FICP would earn from the OBPP's brokerage when the bond is sold. But that changes the incentive. So the mutual fund distributor benefits from keeping assets invested, but the bond distributor would benefit from just churning the portfolio. So that makes SEBI's 2.5% cap worth looking at closely. On a 3-year bond yielding 9%, a 2.5% charge is equivalent to roughly 80 basis points a year before considering compounding. On a shorter bond, the drag is even larger. Stating the cap as a percentage of the amount invested rather than an annual charge makes the same fee progressively more expensive as maturity gets shorter. And there's another problem. Investors may not see the economics as clearly as they would with a mutual fund expense ratio. So if the distributor's compensation ultimately sits inside the price or yield being offered, the investor mostly sees the final yield. And then there's the question of what gets sold. The safest corporate bonds often yield only modestly more than bank deposits, and that leaves less room for platforms and distributors to earn attractive spreads while still giving the investor a compelling yield. But move down the credit curve and the economics get better. But the downside is that the risk gets higher too. Now, comments on the proposal close on September 11th, and after that comes SEBI's final rules and the exchange level machinery needed to make the system work. But there are 3 things worth watching. First is the fee. Does the 2.5% cap survive, and does SEBI eventually require clearer disclosure of exactly what the distributor earns? Second, the platforms. Making OBPPs fully responsible for their distributors creates compliance costs that larger, better capitalized platforms should find easier to absorb. And finally, the distributors themselves. India may have 2.75 lakh mutual fund distributors, but they don't automatically become bond distributors. They still need the fixed income certification. So, how many bother to get it will determine whether FICPs become a genuine distribution network or just another regulatory acronym. Now, SEBI is probably right that India's bond market has a distribution problem, and mutual funds are good evidence that distribution can change how far a financial product travels. But mutual funds didn't become mainstream simply because India created an army of salespeople. The product itself was built for retail, diversified, professionally managed, transparently priced, and relatively easy to exit. So, with bonds, SEBI is now trying to build the sales force around a product that still lacks many of those protections. Now, coming to the tidbits. 1. To improve traceability, the Ministry of Health and Family Welfare has mandated that medical device manufacturers outsourcing sterilization must disclose the subcontractor's license number on their device labels. Domestic manufacturers have raised concerns that the new compliance burden could delay export shipments. 2. Urban Company has filed a defamation and disparagement suit against Kent RO Systems in the Delhi High Court over advertisements claiming its native water purifiers were unsafe and risky. Following a court hearing, Kent RO agreed to pull down the offending advertisements and promotional content within 15 days. 3. The Indian government has strongly reprimanded Elon Musk's Starlink for entering into memorandums of understanding with state governments before obtaining a valid commercial operating license. The move signals regulators intend to strictly enforce compliance before allowing satellite broadband operations to commence in the country. 4. The Ministry of Electronics and Information Technology, or MeitY, is stepping in to help Indian fabless chip designers pool their manufacturing demand. Pooling their orders could give smaller Indian chip designers more bargaining power on pricing, capacity, and manufacturing terms with global foundries. 5. Citigroup and Axis Bank are partnering to capitalize on a leveraged dollar deposit boom in India as the RBI seeks to attract dollar inflows and bolster foreign exchange reserves. Under the arrangement, Axis Bank will provide standby letters of credit to support offshore financing extended by Citigroup. 6. The Finance Ministry has raised concerns over an emerging oligopoly in India's aviation sector due to the current trajectory of airport privatization. The ministry noted that private operators Adani and GMR now account for more than half the country's air passenger traffic, highlighting potential risks to competition and pricing. That's all the news I have for you. Thank you so much for watching and see you in the next one. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.